The Fed admits the economy will crash. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a shocking government report shows a financial crisis is coming this year and that policymakers are going to do nothing to stop it. And this is highly unusual for two reasons. One, we almost never hear a government agency, even in the midst of a crisis, admit something is wrong. And if they did believe so, they're often the first people to step back and start to do something about it. We're going to take a look at why the Fed thinks the economy is going to crash and why they're not doing anything to stop it. Plus, we have a report out of Bank of America which validates what the Fed is saying and that credit is crashing and that consumers now are in far worse shape than we thought. Let's over to Bloomberg, where we picked today's story up with a headline: Fed leans toward another hike to find staff's recession outlook. So again, this is really unusual as we get into the minutes of the last Fed meeting. And so the way this works is after the Fed meets, we have the press conference, and then a while later, we get the minutes from the report. And these minutes are often rewritten a bit as the Fed and the members of the board look back and start to see how the economy and how the markets responded to their statements. And so if they need to make any adjustments, this is where they do it. What's surprising now is they're admitting a recession is coming this year and even have hints that it could be a financial crisis. Minutes of the last month's policy meeting showed officials dialed back expectations of how high they'll need to lift rates after a series of bank collapses roiled markets last month. Still, officials raised their benchmark lending rate 0.25% at the last meeting as they sought to balance the risk of a credit crunch with incoming data showing price pressures remain too high. And so what we have in one side is real-time data. Banks are failing. There is a liquidity problem. Money is disappearing out of the monetary system, and nobody seems to know why. On the other side, we have a very lagging report of consumer prices, which the Fed admits is a lagging report. And of course, we know from the Bureau of Labor Statistics that they too acknowledge that. So it's not a surprise that we're seeing this lagging effect in consumer prices at a time we're seeing a crisis in the banking system. And here we can note from the Consumer Price Index, we got this just the other day, a steep decline in consumer prices. But I want you to note, we keep showing this chart because I want you to understand that policymakers do not understand that the Consumer Price Index is a large function of energy prices. So when you understand this, the idea of what we should expect them to say is, hey, you know what? We've got this banking crisis going on. We don't really know what's causing it, which of course is not something consumers want to hear, but they could massage that address in any way they want, say that, look, we have reason to believe that consumer prices are heading down and the banking system is far more important to us than rising in consumer prices. So since we believe prices are going to come down, we're going to stop with our rate hikes and try to address what's going on in the banking system to keep that from becoming completely insolvent, which, as we know from the last global financial crisis, is not a good way to drive spending. They did so even after hearing from the Fed staff advisors that they were forecasting a mild recession later this year. Now, keep in mind, throughout history, we've almost never had a mild recession. There was a soft recession back in 1994, but beyond that, the idea that we could have a soft recession or a mild recession is really historically highly unlikely. And officials agreed that some additional policy firming may be appropriate. So here you have the case where they start to believe that the contagion risk from the banking crisis is all over. It's done. Whatever happened, happened. We're not sure what happened, but we do know for certain, at least from their view, that it is contained. But the problem is inflation's not. So we need to push more and raise interest rates because they don't believe that anything they're doing has any effect on the banks. And of course, we've made the case that their overnight reverse repo, the rapid increase in rates, and all of the debt we issued during the pandemic is a huge problem for the banks. But as far as the Fed is concerned, hey, the storm has passed. Well, maybe we're just in the eye of the storm for now. Policymakers commented that recent developments in the banking sector were likely to result in tighter credit conditions, shocking admission, for household and businesses to weigh on economic activity, hiring, and inflation. And these are all key points because when banks are worried about money leaving, Of course, they need deposits to back, obviously, loans. So if you have deposit outflow, you're not thinking about lending money because you can't lend money against deposits you don't have. And that becomes a problem because then you have to go borrow from more government agencies. And of course, the credibility of doing so is seen as very poor by investors, consumers, depositors, and even the market. So they don't want to do that. But notably, let's go back to this and see what they said here, because it's really important, that result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation, which we're going to review here in a moment. Against this background, participants continue to be highly attentive to inflation risk. So I want you to note here, they're completely ignoring what the banking sector is telling them. They're completely ignoring it. And we need the banks to originate new loans, to create new money, because that is how our system works. So when you have tighter financial conditions, well, it should lead to a whole host of problems because it means the banks aren't lending. And sure enough, let's take a look at these charts and see. Here we have the net percentage of domestic banks tightening standards for commercial industrial loans of all sizes against the consumer price index shown in red, that on a year-over-year rate of change. And what we can see is as banks tighten standards, and you see the blue line rise above the horizontal black line indicating the standards are tightening, we see inflation starts to peak and then roll over and come down. We see it during the global financial crisis. Inflation surged largely due to crude oil prices, but once again, as lending standards kept tightening, inflation then comes crashing down. We saw it during the pandemic, and we're starting to see it again happen now. But again, the policymakers, they can't see this. They think that this tightening in credit conditions is going to just go away and that everything's going to work itself out. But here we go to the actual Fed minutes now. I want you to see, this is right out of their report, if banking and financial conditions. And the reason I want you to see this is I want you to note that the mainstream media is completely overlooking what this sentence says right here. I want you to see it because it tells you that they do believe that there is a possibility that something much worse can happen. Now, they only mentioned the word recession 3 times in the report, but check this out. If banking and financial conditions and their effects on macroeconomic conditions. So what they're saying is, look, if these tightening financial conditions and their effects on the economy were to deteriorate more than assumed in the baseline of whatever their baseline is, then the risk around the baseline, of course, we're talking about the economy and its trend growth here, would be skewed to the downside. So what they're saying is, again, if this problem in financial conditions tightening is going to make the economy worse, then we're going to see downside exposure for the economy, for both economic activity and inflation, particularly because historical recessions related to financial market problems tend to be more severe and persistent than average recessions. And yes, we know that. We saw that during 2008 and 9. Yeah, it's bad. So what you're seeing here is that some sort of admission that what's going on in the banking sector could cause further problems. But now let's continue on, because I want you to see that the case for hiking again at the next meeting are actually fairly strong. John Williams, the New York Fed president and vice chair for the FOMC, said Tuesday that one or more hikes followed by a pause was a reasonable starting place for the debate as officials approach their May 2nd to 3rd meeting. He expressed confidence, here we go, that the worst banking stress may be behind. Now, I want your opinion. Do you think this thing is over? Do you think they did it? Do you think they put a wall around this banking crisis? Do you think they contained it? Or do you think we're in the eye of the storm and something far worse is coming? Weigh in the comments. Would love to know what you think, as there aren't any signs of a broader credit crunch. Well, John, I'm going to show you there's a whole lot of signs of broader credit crunch with charts from your buddy over at the St. Louis Fed. Some policymakers have also suggested that a pullback in lending could help restrain growth and tame price increases, although the effects are highly uncertain. Of course, we just looked at a chart that showed that, yes, indeed, that when financial conditions tighten, when banks lend less, that you see a downturn in inflation. So we've already proven that, but now let's look at this from the economic standpoint, and then of course we're going to look at this from the labor market perspective as well. Here we're taking that same chart of net percentage of domestic banks tightening standards for commercial industrial loans of all sizes against GDP or the economy in red. And sure enough, as you see banks tightening standards, GDP growth slows. And during the global financial crisis, it outright contracted, which is never good. In the pandemic, it contracted, also not good. But now, with no surprise, GDP growth is slowing, and we should expect in future reports that it should slow. This is what we should see. But now let's continue on. Before we get to the labor market, I want you to see what some other experts are saying. It seems like they can hike in May and ride the tailwind of a slowing in the economy. This according to Derek Tang, an economist at LH Meyer Monetary Policy Analytics. There's a mouthful for you. And credit downturns are historically chaotic. Yes, they are. And unpredictable events. Well, the only unpredictable part is that they get really bad. However, Tang warned that counting on an orderly credit crunch to help retain inflation is risky. Restrain inflation being is risky. These things don't just stop when you want them to, and they can take a life of their own. So what you're seeing from the Fed, and I want to talk about here what Tang is pointing out, is saying, look, these credit crises, they go bad and then they get way worse. So if you're trying to actually create a credit crisis, which the Fed sort of did, and then you think you can contain it, well, good luck. This is like saying, hey, you know what? I've got roaches in one of my rooms in my house, so I'm going to have an orderly burning of that room and hope it doesn't burn down the rest of my house to get rid of the roaches. I mean, that is just not something that you would do. And that's what he's trying to suggest here, is the Fed is making a big mistake in gambling the broad economy with this credit crisis, banking crisis, to contain inflation. And now let's turn to the labor market, where we're starting to see some warning signs. They're not bad yet, but the trend is not good. Here we have initial claims we got from today from last week. Let's start with the good news of this report. We see total claims down about 33,000. They were up to 1.9 million, now down to high 1.8. How about continuing claims? They fell 13,000, but still remain around 1.8 million. Here's the challenging news. And even at 239,000, initial claims are still somewhat low. They rose 11,000. It's not until they get over 250,000 and continue to accelerate that we should start to see some major problems pass through the economy. But do keep in mind, the market can still rally at this point because the market is keyed on the Fed. As long as the Fed is going to pause at some point, stocks don't really care if people are losing their jobs. But now, how about the fact that this credit crunch with the banks and them tightening lending standards is going to lead to more unemployment? You got it. And this is where John Williams can't see it. Here we can now see that same chart we've been using overlaid with the 4-week moving average of initial claims. And here's what I want you to see. Again, as banks tighten lending standards above the baseline black horizontal line there, eventually you see a 4-week moving average of claims start to rise. And you see this happen every time the banks tighten standards and restrict credit. Unemployment claims rise, happened during the pandemic, obviously, and now look, we're starting to see claims rise. And the idea here is the market is going to tell you it's probably not going to continue. But what I want to suggest it is, and Bank of America now, with their recent report, is validating there's a big slowdown in consumer spending. And here we can see from the report on April 12, titled No Madness in March Spending, they note that after starting the year on strong footing, Bank of America aggregated credit and debit card spending per household moderated in March to 0.1% year-over growth, the slowest pace since February 2021. And on a seasonally adjusted card basis, the spending per household contracted by 1.5% month over month. So here you have an indication the economy is slowing. Bank of America has a ton of data on credit cards, and now they're saying, hey, look, spending is dialing down, consumption is dialing down. That means inflation is going to come down and layoffs are going to go up. And the relative weakness in card spending in March was broad-based. This is key, not isolated to one sector, across retail and services. Remember, we just heard about how services in the CPI report was driving all the inflation. We said, no way, it's due to housing. Retail spending and excluding restaurants declined 2% month over month, while services spending, including restaurants, dropped 1%. Do note that services spending remained well above 2022 levels, although retail spending continued on a downward trend. And that trend is going to continue because Bank of America continues to note that lower wage growth as the labor market softens is one of the main drivers behind the resiliency of consumer spending last year, allowing consumers to keep spending in the face of higher inflation. But data now shows that growth in after-tax wages and salaries based on their aggregated consumer deposit data slowed to just 2% year over year. Of course, remember, inflation is running much higher than that. And in these next charts, you can see if you're having a decline in wages, decline in spending, a point where we have high prices, it means lower demand, lower economic output, and the base case now becomes a recession. And with what we're seeing in the banks, you can almost forecast a financial crisis is going to happen. And here you can see after-tax wages and salaries growth based on their consumer deposit data just tumbling. This is terrible. And then you can see after-tax wages and salary by income group, high-income earners seeing the worst effects. Perhaps they're not getting some big bonuses like they were as demand falls, whereas mid and low-income earners are also seeing a hit. And all this portends to suggest that we are not just going to see a mild recession as the Fed wants us to believe, but we're actually going to see an all-out financial crisis. And if they say it's coming later this year, watch out. It may get here before that. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.